Hey everyone, it's Daniel here from etfs. Hope you're all doing well. I got an interesting article here. It comes out from Zero Hedge. It basically says money supply growth fell to a 50-year low in February. Will the Fed panic? Now, money supply growth fell again in February, falling even further in negative territory after turning negative in November 2022 for the first time in 28 years. Haven't seen a negative number in a very long time. February's drop continues a steep downward trend from the unprecedented highs experienced during much of the past 2 years. Since April 2021, money supply growth has slowed quickly, and since November, we've been seeing the money supply contract for the first time since 1990s. So we're seeing it contract at a very steep pace, going into negative territory, and the last time we saw that was in 1990s. Now, during February 2023, the downturn became even bigger as year-over-year growth in the money supply was at minus 6.6%. That's down from January's rate of minus 5% and down for February's 22% rate of 6.9%, with negative growth now dipping below negative 6%. Money supply contraction is approaching the biggest declines we've seen in decades. At no point for the last 60 years has the money supply fallen more than 5.6% in a month, right? So during COVID time, we saw the money supply really move up, right? We had a printing of money. Money was printing and a lot of injection of capital into the system caused prices to move up, right? Supply constraints also prices to move up, and assets like real estate and stocks skyrocketed. And then, right, we went up. What happened? Boom, we're getting a massive drop right now in that money supply, and this is the biggest since 28 years, and we haven't seen such a big drop around minus 6% like they talk about in this article in one single month in a very long time, over the 60 years, right? So money supply growth can often be a helpful measure of economic activity and an indicator of coming recessions, right? So when you get the contraction, when there's less money being circulated in the economy and system, that affects the economic growth, that affects the employment, right? And then it thus hints towards this recession, right? So especially, right, with the whole banking crisis that we're seeing with Silicon Valley Bank and with the Fed coming out and saying that we're going to see tighter credit conditions and banks are going to be, more tight when it comes to lending. And you're hearing stories that banks are reaching out to certain clients and saying, hey, we've given you this line of credit of $100,000. I got to take some back from you. Your line of credit is now $50,000 or $20,000, and that's because you don't utilize it that much. So we're just going to take it back, right? These are the constraints. So when the money supply starts to depreciate and deplete very quickly, right, you're putting less credit in the system. You're basically going to slow down the growth. You're going to slow down the growth of many businesses. You're going to increase the unemployment rate. And if the businesses are slowing down because hey, their line of credit of 100K just shrank down to 20K, then they're going to be in much more of a tougher situation, especially if they relied on that 100K in times of recession, in case they need that liquidity and that cash flow, which could lead to even businesses shutting their doors, closing their businesses, which would be probably worse off, which we could see in this recession, worse off than 2020's recession, than the COVID recession, right? We heard about the lockdowns. We heard about the government saying stay at home, and a lot of businesses shut down and went under. My opinion on all of this is that this recession that's coming up with the lock of on credit and money it's going to make it even worse, and you're going to see maybe same levels or worse off levels of businesses shutting down, which is not going to solve the problem down the road when it comes to prices and inflation. Because if you had, let's say, 5-10 businesses supplying you, let's say, lumber, and then out of those 10 businesses, let's just say hypothetically, right, six of them decides to go under and close their doors, right? You now have 4 businesses that you're going to rely on, and then when the next boom comes and they inject money all over again, didn't really solve the problem, right? You've got 4 businesses to rely on, and if everybody rushes to the door and says, hey, I need lumber now, those prices are going to move up, right? Those prices are going to move up because, hey, there's still shortage problems, right? The money supply and the recession and the rate hikes can do its effects maybe temporarily, but you got such a big shift that happened through COVID, through the supply chain, through the war between the West and the East, US versus China, plus now this recession, that could really change things up. So let's continue with this article here. It says here that negative money supply growth is not itself an especially meaningful metric, but the drop into the negative territory we've seen in recent months does help illustrate just how far and how rapid money supply growth has fallen. That is generally a red flag for the economic growth and employment, like I said, right? So they're saying that, okay, the supply growth, the number itself is not, crazily meaningful, but the fact that you get into negative territory, and especially at such a big level, does point out a red flag when it comes to the growth and employment. The fact that money supply is shrinking at all is so remarkable because money supply almost never gets smaller. And true, if you look at the money supply over the years and years, it's just like a straight line, and then COVID hit, and then boom, you've got this massive move up in the money supply because they pump so much money. Now, you do see little dips, right? But overall, the trend is they just keep pumping money. And why is that, right? Why is that? Because the whole system as a whole is dependent on credit. The only reason you're interested in the stock market or real estate, or the only reason why we have growth today, the only reason why the US dollar is the world reserve currency, why US continues to grow and prosper, is because of credit. Credit. If there's no credit, there's no debt. Then we will not be interested in any of these things. And actually, the economy will do poorly. So you need credit creation. You need this new inflow of money chasing the same amount of goods, right? Same amount of assets in order to cause the prices to move up. And that's why money supply continues to go up and up and up, right? And it will continue to fuel the asset price inflation forever, right? Even though there might be small dips, right? Don't think that there's no dips. There are small dips, but it will come back up and surpass those dips, and those dips will mean nothing later on. So going back into this article, the money supply has now fallen by 1.7 trillion or 8% since the peak of April 2022. In raw numbers, that's certainly the largest fall we've seen, but we can see in the next graph why, in percentage terms, the drop doesn't beat those of late 80s and early 90s. Money creation since 2009, and especially since 2020, has been so large that even a drop of 1 trillion is relatively small in percentage terms. Rather, the money supply would have to drop another 5 trillion or so, or more than 25%, to return to pre-2009 trend, right? And I'll link the article so you could read up on it and follow along. But basically, they're saying here, right? The money supply, the amount of pumping and printing that has been done, this $1 trillion little dip, it does nothing, right? It's very small, right? So, the idea of the Fed coming out and jawboning and causing through the communication, through their FOMC meetings and whatnot, to kind of cause the markets to react to create the tightening conditions is one methodology. But if that doesn't work, right, and the current money supply that's going down is not enough, right, and we don't have to get to pre 2009 levels, right, but the amount of money printing that was done during 2020 during COVID time, right, in order to see inflation come back down, you got to reverse a lot of that money printing that has been done. And that's what we're seeing right now. Which means what? Which means it's possible, right? Not 100%, right? Unless something does unfold in the next coming months or by the end of the year or 2024, right? Like a big recession. But it's possible that you could see if growth is not deteriorating and employment is still strong, you could see the rates higher for longer, the yield curve continuing to invert, and the QT and the QT, quantitative tightening, the taking out of money from the system continue. The credit conditions continue to tighten, and that's what's going to happen until something breaks, right? So even though the money supply is going up, now we're seeing a little bit of a dip. This will continue, tightening will continue, and like we've heard from the Fed and many central banks, right, that we will keep rates. So sticking to just the US Fed, we will keep rates higher for longer, and we will create tightening conditions for longer, is basically, in other words, what they're trying to say is we're going to keep conditions tight until something breaks, until something fully gives up. You know, it could be the commercial real estate, could be the banking sector and so on, that completely gives up, implodes, and finally that brings the inflation down because, you know, we did too much money printing. We pumped way too much money already. That messed up things. And now with supply chain issues and COVID that happened, and with the war with the West and the versus the East, it's making the job even harder. So let's keep things tight until something breaks, and hopefully that will bring inflation down to our 2% target. So that's the idea. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.